Hello guys, my name is Marcos Mia. Welcome to my YouTube channel. In this video, we're going to be talking about some of the best ETFs to invest in by age. Now we're going to have three categories. The first being your 20s and 30s. The second category is your 40s to early 50s. And the third category being your mid 50s to retirement or around age 65 and up. Now before we begin, we first have to go over some assumptions. The first being that we are not purchasing all these ETFs or blindly copying my portfolios because we're going to have 10 for each category. So you should only be choosing the best ETFs for your goals and needs, as well as your own specific risk tolerance. So don't be blindly copying the ones I choose. Always do your own research. Number two is going to be that we are dollar cost averaging. So we're going to be dollar cost averaging into the ETFs that we choose of passively investing into our stock portfolios. And the third being that these ETFs are based on the age you start investing. And lastly is, of course, I am not a financial advisor. This is just going to be my own opinion. So now with the first category being our 20s and 30s, we're going to have a risk scale of 1 to 5. 1 being the least amount of risk, 5 being the most amount of risk. So this category of ETFs being our 20s and 30s is going to be around a 4 to 5 on that scale. So it's going to be a lot more higher risk, but hopefully higher reward. Now, the goal for these ETFs are going to be targeting ETFs that have growth indexes as well as dividend growth ETF strategies. Now, when you're young, we can afford some more higher volatility. So these will be a little more volatile as we have a longer time horizon. And you might see a lower dividend yield since we're looking for growth and capital appreciation than current dividend income from something like a covered call ETF. And we do have index plays for longevity and playing the long game of passive investing with stable, reliable returns. So all in all, some of these ETFs might have lower dividend yields, but we're going to be having higher growth in share price appreciation. So now some of the ETFs that you might see, for example, we have 10 holdings. We have a dividend yield of the average from these 10 are 1.4% dividend yield. And we have a super low expense ratio of 0.7%. because we're going to have a lower expense ratio as we are passively investing. And of course, we have a lower dividend yield because some of these ETFs do have growth and index plays, which mostly reinvest their capital back into their businesses rather than giving dividends to investors. So now some of our ETFs that we do have are going to be some growth plays such as QQQM, which is a NASDAQ tech ETF, schg, which is another growth ETF with heavily leaning towards technology, XLK, which is a technology sector ETF, Vanguard Growth ETF, which is another ETF for higher growth in the future, BGT, which is an information technology ETF. And I think that the summary of these ETFs is going to be very heavily into technology, which is typically a growth sector. So with technology ETFs, they will be higher returning, hopefully a lot volatile than something like a dividend growth ETF or a dividend stability ETF. And most of these ETFs will be heavily leaning towards technology, like I just said. And we do have some index plays though. So we do have a portion to VOO, which is an S&P 500 index fund. We have VTI, which captures the total stock market. And we do have some other dividend growth plays, such as dgro, which is a dividend growth ETF, schd, which is also a very quality dividend growth ETF. And some of these ETFs are going to be for these specific goals. We do have a longer investing time horizon to hopefully rack up these dividends in the future, to have some huge dividend payments and as well as huge dividend appreciation and capital appreciation from our ETFs. So we do have EIG, which is a dividend appreciation ETF, which does appreciates dividends in the future. So now our second category is our 40s to early 50s. Now the risk associated with this category is a 3.5 to 4 from our original scale of 1 to 5. So this will be a little bit less riskier than our 20s and 30s, around in the middle of the line risk associated with this ETF category. Now the goal for this category is to have a lot more higher dividend yield, as well as good growth to manage our risk. We will get this growth and higher dividend yield from our indexes, as well as high quality dividend ETFs. Now we will have no growth ETFs to avoid higher volatility, as well as mitigate our risk during market pullbacks. Now the ETFs I included are going to be ETFs that are going to be a lot more of average growth, but they're going to be a lot more stable and reliable than our 20s and 30s, which is going to be a lot more aggressive growth, aggressive dividend appreciation. Now, as you can see on your screen, we're going to have 10 holdings, a lot higher dividend yield of 2.5% compared to our original category. And we will have a little bit of a higher expense ratio of 0.13% on average from all 10 of these ETFs. Now, we do have 3 ETFs that will be targeting our indexes. The first being DIA by Spider, which is that Dow Jones Industrial Average ETF. Our second being VOO and VTI, which is those Vanguard index fund oriented ETFs. So now these ETFs are going to be primarily served as that stability of stable returns, a lot average growth, but they will be a lot more reliable, with historically providing great growth as well as a little bit of a good dividend yield. ETFs included in this category is a lot more dividend-oriented ETFs of dividend growth, dividend appreciation, and higher dividend yielders. For example, we do have DGRO, Noble, schd, SDY, and VYM, which are those higher dividend yielding plays of dividend aristocrats, as well as dividend stocks that aren't going anywhere. They're going to be stocks that are going to be providing great revenues, and they're going to be reinvesting that capital back into you as an investor to hopefully get higher dividend yields. And thus, their share price will grow, as most of these stocks included are going to be very sticky stocks with very sticky products, and they're going to be growing both their dividend as well as their share price. Now, we do have VNQ, which is a real estate ETF. I did include it for that higher dividend yield of over 4%, as well as if you want to diversify in something else as an alternative investment, you can do something like real estate. Now, you don't have to do VNQ as a real estate ETF. You can include some real estate stocks such as Realty Income or VICI, for example. And we do have our last ETF being VTV, which is that Vanguard Value ETF. So value is the opposite of growth, and growth-oriented ETFs are going to be a lot more risky, a lot more volatile. Now, value is going to be a lot less risky, a lot less volatile, but will have a higher dividend yield and provide some stable and reliable growth in your portfolio. So now our last category is our mid-50s to retirement or age 65 and up. Now, the risk associated with this category is going to be a 2 to 3.5 from our scale of 1 to 5. So this will be a lot less riskier than our other 2 categories on the lower end risk scale. Now, the goal for this ETF category is going to be mainly capital preservation. So we're going to be putting our capital to use in the form of dividends received either quarterly or monthly. Now, the overarching goal of this category is going to be higher dividend yielding and lower growth. We do have 10 holdings, and on average, these 10 holdings produce a dividend yield of 6%, which is a lot more than our other 2 categories, as we are focusing on a higher dividend yield. And mostly we're going to have covered call ETFs as well as some higher dividend yielding investments. Now, the expense ratio is going to be a lot higher than our other 2 categories at a 0.28%, mainly because we do have a lot more actively managed funds. Now, actively managed funds are going to be a lot more expensive to hold than passively managed funds. That's why that expense ratio is a little bit higher. Now, in our covered call ETF category, these will be a lot more dividend payments. So they will be paid more monthly on a monthly basis than a quarterly basis. Now, the ETFs included in that covered call ETF strategy is going to be some of the best in the game, such as DVO, XYLD, SPHD, JEPQ, and JEPI. So these are going to be some of the best ETFs for a stream of passive income in the form of dividends paid monthly. And these are going to be a lot of a higher dividend yield, and they're going to be a lot less volatile than something like a dividend growth strategy or a dividend appreciation strategy. Now, we do have a little bit of a less of a higher dividend yield than a covered call ETFs in the form of some of the best in the game, such as VYM, HDV, and SEHD. Now, these dividend ETFs will have a dividend yield of at least 3%, some going a little bit higher than that, but they will be providing some great growth in the future. If you do have a little bit of around a 5+ year time horizon, these will provide some great growth in your capital, but do having a higher dividend yield in the form of dividends. Now, you do have some alternative investments in here, such as some long-term and short-term bonds by Vanguard. You can have a high-yield savings account as some stream of interest rate payments. So there's going to be many ways to invest in your retirement. These are just some of the best that I believe are going to be some of the best in the game for those years. Now, with all that said, those are my best ETFs to invest in by age. Now, hopefully you guys enjoyed this video, and hopefully you guys can give this video a like because this cute puppy did, and comment down below if you agreed some of these ETFs that I included in these categories or some that should be included that I might have missed, because there's so many ETFs to invest in, and I'm sorry if I did miss the ETF that you do love and like. Now, hopefully you guys have a great rest of your day,